Hello, everyone. It's Thursday, December 1st. Happy December. Today, we'll talk with Julius Kempenaer of RRG Research. We'll talk about sector rotation. Certainly has been forefront for a lot of investors recently as value sectors have been dominating. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a snowy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts. Julius Kempenaer, my guest, and Zach, our technical director, and I were watching the end of the World Cup matches there as we prepared for the show. I don't know what is more disconcerting and uncomfortable, watching the World Cup results or watching the markets. And today is honestly on the market side is what I would call a digestion day, right? Think of yesterday as your big Thanksgiving meal. You've loaded up on growth-oriented turkey as the markets have rallied significantly during Powell's press conference. Today is sort of that uncomfortable feeling afterwards where you're digesting that big meal. So unclear as to what happens next, right? We talked about 4,100 in the S&P as being a key level. We touched there briefly right after the open, but the rest of the day was more choppy. End of the day, the S&P not going much further away from where we were at the close yesterday. Great guests on the show. Thoughts for Miss Schneider. She had a family health issue and had to opt out. Julius Kempenaer, a very capable guest, was willing to step in for us, and we're super appreciative of that. We'll get Mish on again very soon. Next week, we have three really good guests for you. John Kosar from Asbury Research. On Wednesday, the 7th, Leslie Juflas from here in the Seattle area joining us. And then on Thursday, the 8th, Frank Capilleri just recently launched his own research platform. So excited to talk to Frank and get his take on this market environment. As a reminder, the StockCharts holiday special is live and it is ready to go. You probably noticed some banners at the top of our website. Go to stockcharts.com/special. If you have ever considered being a premium member of StockCharts, this is a really good time to do it because it is the best time of the year to do so. Let's continue on our show today with our market recap, and we'll talk about this market environment. I've had a lot of conversations recently about weakness in the U.S. dollar, which certainly has been a key story, about strength in stocks coming up to off of the October low. You know, when I'm looking at the charts today for my monthly chart review for my market misbehavior premium members, we looked a lot at the dollar approaching its 200-day moving average from above, the S&P testing its 200-day moving average from below. We're at a really key point here, and I think we're very close from a full-on risk-on look with stocks breaking out and a full-on downtrend in the dollar, even further than what we've seen so far. But we have some key levels to eclipse first, and let's talk about those as we go through the charts. As I mentioned, the S&P not real changed from yesterday. The end of the day, essentially an unchanged day, 4076 at the close. The Dow down about 0.6%. It's interesting. I'll show you one of the charts later. The traditional Dow theory, looking at the Dow Industrials and the Dow Transports. The Dow Industrials, one of the few indexes that have actually already gotten above their August high. The Nasdaq Composite up just a little bit, but no real change in these indexes by the end of the day. The VIX continued to push lower, by the way, and it's back below 20, and it has not spent a lot of time below 20 here in 2022. Most of the time, 20 has been a pretty good opportunity to sell stocks because low volatility has been matched with these bear market rallies. That's where the uptrends have exhausted. So for what it's worth, we're right at the volatility point where the markets have often turned from a bear market rally back to the downside. Quite a bit of movement in the fixed income markets with bonds moving aggressively to the upside, continuing the trend that we've seen recently. Interest rates really coming off. Powell's comments yesterday saw the 10-year yield come down to around 370 today. We almost got down to 350. Talk about a move lower in interest rates. Now, I think one of the great stories, and I was talking with my guest yesterday, Javed Mirza of Canaccord Genuity, we were talking about the interest rate environment and how the fact that rates have been rising creates an unusual circumstance that most of us have not really experienced in any significant way. We're pretty much have learned to invest in a falling rate environment or in a low rate environment. Rates have come down, but I would argue overall the trend has been higher rates. And I don't know if that's necessarily done, particularly as the Fed has made it clear they're planning to raise the short end of the curve here over the next 3 to 6 months. But for the short term, rates coming down, the 10-year yield almost hitting 350 today. The dollar index moving down as well. And again, the only way, in my opinion, that stocks move up significantly, meaningfully further than they have so far is if the dollar continues to weaken. So the UUP down about 1.2% from yesterday's close. If you're looking for charts that have really shown signs of improvement, bond prices, certainly one, like the AG or the TLT, also gold prices, right? Look at gold or silver, both having a pretty decent run here. The GLD was up almost 2% today and silver up a little bit further than that. The more energy side of commodities not looking as strong. So the broader commodity ETF, the DBC, was down about 0.5%. Today's guest, I just heard, was termed Julius the Bear for his commentary on cryptocurrency. So we'll see if we can get him to talk a little bit about Bitcoin or Ethereum. For what it's worth, Bitcoin down below 17,000 today. That's after popping up into the later part of the day yesterday, down about 1.6%. Ether prices back below 1,300, down about 2% from yesterday. Let's look at a chart of the S&P 500 and see how all of this plays up. So one of the things I mentioned, again, for my monthly chart review that I do every month for my own premium members at Market Misbehavior, we talked about 2 charts that I'll share with you now, actually 3. The first one is the S&P 500. And if you look at a trend line from the January peak to the March peak to the August peak, connect a trend line using those highs, and we get right to around 4,100. Coincidentally, that's almost exactly the intraday high today. We literally traded right up to this trend line and came off a little bit. I've been talking as we've had this rally phase, what are the key levels to watch? And we talked about something like 3,800 as an initial resistance. We blew right past that. Talking about 4,000, which is a key Fibonacci level. We've tested that a couple times in November and resolved through that on the rally yesterday. The 200-day moving average around 40.50. We left that in the dust yesterday as we closed above the 200-day for the first time since April. The last line of defense, I would argue, in a way that allows me to continue to call this a bear market rally before I have to change that terminology, is this trend line using the 2022 highs. We have bumped up against it. And my question would, for this month of December, do we power through it? Now, the seasonal tendencies would tell you it is a safe bet that the market moves higher in November and December. November certainly played very nicely with the seasonal tendencies, having a pretty strong month. And a lot of the indexes, like growth stocks, having a fantastic November. And this week's bounce on the Powell press conference yesterday was just one piece of that overall uptrend. But I think for now, the question is, can we complete this rotation and get above 4,100? We get above 4,100, I will stop calling this a bear market rally and start thinking about further upside potential. And back of the envelope, the first thing I'll be looking at is 4,300, 4,325. That's another Fibonacci level. That's the August high. That would be an important level to certainly watch. And that could be the upside objective through year end if we're able to get through 4,100. And that is a major league if, in my opinion. Now, elsewhere, other things to look at. When we talk about the strength in stocks, we have to talk about the weakness in the dollar, because I would argue that, really the only way that the market's able to rally, the equity market's able to rally in October and November, is with the dollar weakening. We've called the dollar the wrecking ball for risk assets. And for much of 2022, on the average week, it's been sort of strong dollar, weaker everything else. That's been a common refrain up until the last 6 weeks, when that has started to change quite a bit. The dollar's starting to make lower highs, the dollar making lower lows, breaking below its 50-day moving average, which was significant because that has served as support through much of 2022. Now we're testing the 200-day moving average, and we've been above the 200-day since June of 2021. It's been quite a long time. This also, 105 on the dollar index, also represents a 38.2% retracement from the May 2021 low to the September 2022 high. We have now retraced 38.2% of the way. The 200-day moving average is right about at that level as well. So we have a lot of indications suggesting that we're right at support. So just like the S&P testing resistance, the dollar testing support. The question is, are we able to eclipse those levels and break through and really change the character of this chart? Another chart I want to get to, looking at the VIX. I'm going to save that a little later in today's show. We have a segment called Getting Sentimental. We'll talk about volatility, some survey data, some charts I think you definitely need to be following. Let's take a quick commercial break. We'll be back with today's guest, Julius de Kempenaer. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close as we break down the activity in the markets using the technical toolkit. Technical analysis and charting is really designed to help us understand these markets and not necessarily understand why trends are evolving, but respect how they're evolving. And that's when we talk about key levels, key inflection points, key movements. It's less about what could happen or should happen. We are focusing on what is happening. And if you are underappreciating the lessons of price and trend and momentum, hopefully this show helps to alleviate that and focus your attention on the trends in the markets. We have a great guest today. I'm super thankful Julius de Kempenaer is able to join us and talk to us a little about rotational trends. Did want to mention a couple things before we bring Julius on the show. First off, we welcome your questions. We had a great mailbag segment on Tuesday's show. We'll do another one on tomorrow's show on Friday, and we'd love to feature one of your questions live on the air. You can get your questions to us via email, thefinalbar@stockcharts.com, via Twitter @finalbarsctv, and via YouTube. Just put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. We have so much great content every trading day. I was just watching Joe Rabel and Bruce Frazier had a really interesting discussion about Wyckoff and swing trading, which I thought was really well done. Larry Williams' most recent market outlook was posted a couple weeks ago, and so much other great content available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Julius de Kempenaer. Julius is the founder of RRG Research, pioneered this idea of visualizing the sectors in a true rotational format using his RRG methodology. Julius, great to see you. Welcome to the show.
Yeah, happy to be here, Dave. No problem.
So we've talked a lot about rotation in your visits to the show, and we've had a lot of questions recently about this surge in growth-oriented sectors, right? Out of the October low in the markets. We're looking at your weekly RRG here. Talk us through what you're seeing looking at the graph here.
Yeah, people who follow my show on Tuesday, Sector Spotlight, they will know that I've been talking about the dominance of defensive sectors basically throughout the year. What we've seen is that healthcare, utilities, and consumer staples were basically continuously leading the market. They were either inside the leading quadrant or they were inside the weakening quadrant and curling back up. Even when the S&P was going higher, and when these three defensive sectors are dragging the S&P up, to me that is a warning signal. That's under the hood, is that because these are relatively small sectors, and if people are pouring so much money into these defensive sectors so much that it can actually drag the S&P up, that says something. That tells me that the market's going defensive. That is now changing to a degree. If you look at utilities, is the best example. That is the lowest one on the RS momentum scale. Exactly that one. That's powering into the lagging corner. That's not a good rotation. That is people moving out of utilities, out of defense. We still have staples and healthcare inside the leading quadrant, but staples is the one that's probably the best, and healthcare is kind of rolling over. That is still going in there, but look at the difference between the tail length of staples and the one in utilities that we just saw. That utilities tail is super long. That is a lot of power, a lot of momentum behind it. If you look at that staples trend, that staples tail, that's really short. That means that it is kind of stable, but it's very close to the benchmark. So there's not a lot of power left in that. And if you then go to healthcare, which is just a little bit up, right, exactly there, that has already rolled over. That is now starting to lose relative momentum. So the dominance of defensive sectors is fading. Let's call it fading. By the way, I just loved your acronym, like a growth-orientated Turkey. I was like, Where do you get that from? But this is your, I don't know, this is your growth orientated turkey. Their defense is digesting what has been going on. On the other hand, it's not that these cyclical sectors are really all powering off. So we still have consumer discretionary, which is the biggest cyclical, moving right into that lagging quadrant. So that is balancing out that loss of defense with also a loss of offense through discretionary. Materials, on the other hand, is right moving in the opposite. So that is an offensive sector which is going nicely into the leading quadrant. So to me, what's happening under the hood is that sector domination, sector rotation is kind of shifting. There's not one direction anymore. And maybe that belongs to that bear market rally, doubt of people in the market, is kind of a hesitance of going all bullish or all bearish. Investors don't like uncertainty. And I think that from a sector rotation point, that's exactly what we're having right now. There is no clear leadership anymore. There's a few of those sectors that are now starting to pick up. And I wrote a blog article on Monday, Tuesday, basically saying like materials, industrials, financials. Those three sectors are looking really nicely from a relative perspective. And they also have very good price charts, which are very close to breaking out. Or when you bring up the industrial sector, I think that today is actually bringing it higher on price as well. All three of those charts look kind of similar. They came down from their highs. They formed something that looks like a double bottom, maybe not all the elements of a double bottom, but had good support. And they're now pushing against that resistance coming from that peak in between those bottoms. Industrial seems to be breaking higher, but these are weekly charts. So we really have to wait until tomorrow's close before we can finally make the call that the breakout has taken place. Industrials looking very good at the moment. Financials probably has the most potential once that breakout comes.
We only have about 30 seconds left, Julius, but I did want to bring up your chart of the industrial sector. You mentioned materials just moving into the leading quadrant, industrial sort of heading northeast, kind of in a position of strength. What attracts you to a chart like this?
Well, the combination of the strength and relative strength, the strength and relative, and then especially the fact that we get a confirmation in price. We're breaking above that previous high. And I mean, I think it's really that those two lows there that trend has not been strong enough to call it a double bottom. It's too big, but it kind of looks like a double bottom. And we're breaking above previous resistance. So that is a good thing. So you get confirmation in price, which is supported by relative strength, which means that you're probably investing in one of the stronger sectors in the market right now.
Julius, thanks so much for highlighting some of the areas of strength in the market. Thank you for stepping in and sharing some fantastic insights with us. Stay safe, be well. I won't wish you well in the USA Netherlands on Saturday, but I hope you enjoy the game, my friend.
Yeah, I hope you do too.
That's Julius de Kempenaer. Julius is the founder of RRG Research, coming to us from Amsterdam, and has been incredibly gracious, cheering for the U.S. team along with the Netherlands. We will keep it civil and enjoy talking about the World Cup continuing on. But what I love about his illustration, we talk about that, focusing on areas of the market where you're seeing strength. And, I was taught early on when I was learning technical analysis, buy low, sell high, buy weakness, sell strength. That was the approach. And in a swing trading short-term environment, that's true. Talking with people like Julius, talking with money managers at Fidelity, I learned there is another approach, which is more of a growth-oriented, momentum-oriented approach, which is strength begets further strength and weakness often begets further weakness. And I think Julius's RRG beautifully illustrates that approach. Julius is founder of RRG Research. His show Sector Spotlight is a can't miss show on StockCharts TV every week. Let's continue on with our show today with our next segment, Getting Sentimental. This is where we check in on some of the sentiment data. A lot of that data is updated on Wednesday and Thursday, so it's a really good time of the week to check in on sentiment data and see what we can see. The VIX chart I alluded to earlier when we were talking about our market recap. This is a chart we've highlighted a number of times here recently and really in 2022. The way I think of volatility, and it's funny, every time I post this chart and I add some comments, I get plenty of pushback. I feel like that is the nature of social media in 2022. All the trolls will push back on things, which is fine. But one of the things that I try to remind people is I think of volatility in terms of volatility regimes, right? There will be a period, often with the VIX, it's around 6 to 12 months, where you will have the volatility settle into a certain range. And that's sort of capturing that intermediate trend for stocks, right? That 6 to 12 month run, where we sort of have a particular trend. It has a particular character to the chart, and at some point things change. And I often call that a change of character, right? There's a certain look to the chart, a look and feel, and all of a sudden something is different. Usually there's a new catalyst or a new reason why the chart tends to evolve. If you look at the VIX in 2022, we've had a pretty clear range, right? On the lower end, it's a VIX of around 20. On the upper end, it's a VIX just above 30 to 35, we'll call it. And if you just look at the times about when the VIX has gone above 30, that is usually lined up pretty well with tradable bottoms in 2022. When the VIX has come down to 20 or just below that, that has usually coincided with pretty significant market tops. So it is well worth noting, in my opinion, that the VIX has come down from above 30 to right at 20, and today actually going below 20 for the first time since August. You can also see, of course, this has coincided with the rally on the S&P 500 and the major averages off the low in September and October, rallying to a new swing high here. But the VIX has come down. So one of two things happens, right? The 2022 playbook continues into 2023. This ends up being an ideal selling opportunity as the VIX tests trendline resistance at 4,100. The VIX bottoms out at 20. Volatility expands as people get scared out of these markets and go lower. On the other hand, we continue through there. And that's why I think watching the VIX here is important. Can the VIX get below 20 and stay there? That's all of a sudden where it starts to look a little bit more like the middle of 2021, which is more of a steady incline. It wasn't just an initial thrust off of the lows, but more of an accumulation phase where it's not just an initial push, but more what we may call the smart money and maybe others continuing to accumulate positions here. So that's why I think the chart of the VIX is important at this point, right at the point where if this is a bear market rally, we're right about at the point where this should be exhausted. Let's see what actually happens. Survey data, kind of interesting. Over the last couple of weeks, the bears have not changed much at all. We've been right around 40% bearish in the AAII survey over the last 3 weeks. The percent of bulls have actually come down every week. So we're around 30, 32% a couple of weeks ago. Now we're down to around 25%. So obviously way more bears than bulls, to the tune of around 16% bears over bulls. If you look, in the really bombed out phases, we've seen a spread of around 40%, meaning 40% more bears than bulls in this weekly survey. What's interesting, though, is at the as this sort of bullishness has waned a little bit, look at where the indicator is now, right? As we rally here and are testing the 200-day moving average or the 40-week moving average here. Back here in March, we had net positive. This is the last time we actually had net more bulls than bears. This was in March of 2022. In August, when we tested the 40-week moving average, it was almost a zero, right? It was around 5%. Still more bears than bulls, but very, very close to being even. Now, all of a sudden, we've rallied, and we're not at that point. As we test the 40-week, we're actually seeing an expansion, really not an expansion in bears, but an evaporation of bulls. So over the last couple of weeks, the market's rallying, but less and less people optimistic about that, which I find a really interesting sort of contrarian movement as the market is rallying. And instead of an overwhelming amount of bullishness, I would argue if this uptrend is to be believed, I would probably expect to see more bulls than bears out there. And we're not there yet. It's a 15% spread between the two. Another interesting point here, if you look at the name exposure index, this is a survey of money managers, active investment managers, and they're asked for their equity allocation. How much are they allocated to the equity market? You can be long, you could be leveraged long up to 200% long, also up to 200% short. And this shows you the responses in aggregate of all of those different money managers. It's currently at 64%. What's interesting is this is less than it was in August. The August test of the 200-day, we were around 70%. In March, we were up above 80%, around 82%. So even though the market is rallying once again, there's actually less and less optimism on the money managers in this survey. This tells me a couple things. Number one, there's a little bit of skepticism as the market is rallying relative to some of those previous peaks. Maybe the downtrend in 2022 has really taken its toll on the optimism of a money manager. But it also tells me that if there's a sustained rally here, there's a lot of sort of powder left in the keg, if you will. There's a lot of opportunity for more bullishness if investors are going more and more to the long side. Same could be said for the RIDEX flows, right? This shows you within the RIDEX fund family. Are you on the more, are investors in the RIDEX funds more on the bullish or the bearish allocated funds? And at this point, around 0.17 is kind of middle of the road. If you look at where we've been for the last 5 years or so, we're kind of right at the midpoint. Now, it's fluctuated quite a bit. And you'll notice here that the low in 2018, the low in 2020, and the low in October of 2022, the RIDEX flows are right about at the same level. That may end up being one of the better signals. If this does end up being the low for the year, which it certainly could be, and if we rally in 2023, which I don't see as the most obvious scenario, but is certainly a possibility, looking back at the RIDEX flows could be one of the great reminders of using sentiment indicators and positioning data to look at previous bottoming patterns. Finally, just to highlight on the put-call ratios, we have the total put-call ratio. I'm going to go quickly just because we're out of time to the equity-only put-call ratio. The raw data is in gray. I actually have that muted on the chart. I tend to look at a 5-day average because this is reported daily, and it's a really noisy data series. You can see just over the last month, you can see how much the daily put-call data has fluctuated from way below average to way above average. Right now, the raw data most recently, we've seen a lot of spikes, including today's reading, way above 1, which basically means that puts far out pace calls, and it could be an interesting data set to watch. In black, I've highlighted the high that we saw for November, and we're getting back up close to those readings. The trend in the put call ratio has become more and more positive. What's interesting about that is you usually have on a rally in stocks, you usually have a decline in the put call ratio as a contrarian signal. You can see the put call ratio at the March peak. The put call ratio in the August peak, sort of the lower end of the range, around 0.5 or even a little lower. Now we're again having a rally phase, but the put call ratio is actually fairly elevated. So some of these sentiment indicators are changing quite a bit. And when we think about a change of character, I'm seeing evidence in the sentiment data saying that certainly could be the way that this is playing out as we go through December and into the new year. We need to wrap the show, folks, and go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. Dow theory, traditional Dow theory, as Charles Dow envisioned it, looked at 3 things. Looked at the Dow Industrials, 2 things, the Dow Industrials and the Dow Transports. And he really looked at what was called the Dow Railroad Index at the time. But looking at a confirmation between the two is often a great way of confirming a new bull market phase. What's interesting is the Dow Industrials is one of the few indexes to actually make it above its August peak. The Dow Transports have not quite done it. The S&P and the NASDAQ Composite clearly have not broken their August highs as well. So at this point, what you need to see for a Dow theory bullish confirmation is the Dow Transports to get above around 15,200. That would turn that into a bullish phase. We are not there yet. Chart number 2, the name exposure index. It's interesting to me as we're looking at the weekly name exposure index, looking at the chart of the S&P above. We are at a lower level than we've been at previous bear market rally ends, right? At the exhaustion point, you've actually had more optimism from the survey than we've seen so far. I think one of the takeaways for me is that we are not done yet, right? I think there's an opportunity for the market to go higher. Look at what we did coming out of the March 2020 lows, and look at how quickly a couple of months later, you see how the name exposure index continued to increase. And that's arguably one of the sort of general ideas that fueled further upside. The market has rallied and the name exposure index is still below average, which is around 70 to 80%. Do we see further upside in that sentiment indicator? The bull market argument, I think the bull thesis for stocks involves these indicators both going higher, meaning the name exposure index increasing, telling you money managers are putting more money to work in equities, and the RIDEX flows getting lower value, sort of increasing on this chart, showing that investors are getting more optimistic. Finally, as always, let's try to finish the show on a positive note. One of the biggest gainers in the S&P 500 today was Etsy. Etsy's an interesting chart because it bottomed out in June, rallied into the mid-August peak. From there, tested that peak again here a couple of weeks ago, and now this week, powering through. Nice move to the upside yesterday, breaking above resistance, but today continuing to push to the upside. Nice follow-through day. Folks, that's a wrap for the show today. Special thank you to Julius de Kempenaer from RRG Research. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.